So thanks everybody for being here. A couple of things before we get started. I do want to remind you that we have a campaign going with the National Restaurant Association to replenish the Restaurant Revitalization Fund. This was a fund that went through with the last Federal Relief Act, and it was $28 billion for our industry. Unfortunately, they've had applications up to $60 billion, and only 28 billion of that will be given out. And so we're asking them to help our industry by replenishing those funds and giving the relief necessary to everybody who has applied for those, or at least the applications that are legitimate. A couple of things that are happening. We're back in business here at the association with our ServSafe Manager certifications. We have a couple of Spanish classes coming up, and then we also have some regular English classes. And so for those of you who need to get your certification, please don't hesitate to let us know and register online. Of course, you can go to our classes and events and our calendar and register there. And so we look forward to seeing you all again. We're doing the majority of our training right now in our training room here at the Restaurant Association, which is in Albuquerque on Montgomery. Eventually, we'll get back to training in other cities. You know, we're just doing this. It's baby steps, just like reopening your restaurant right now. If you need to, you can get to the red to green reopening map right here. Don't forget that we have a podcast now, and we've had 22 episodes so far. It's been a lot of fun for me because I get to interview all of you, my members and the members of the Restaurant Association, and it's been just a lot of fun. We'd love to feature you, so please don't hesitate to let us know. You can click on this right here on the front page, the home page of our website, and be featured on our podcast. And then something new that we just added was, if you missed our email, or if you missed, you want something and you want to get back to something, you can always go to our latest news right here on our homepage. If you are not signed up for our newsletter, we try to be really careful about what we send out. It's only things that really should matter to you. And you can subscribe here. And then the rest of the website, you know, we try to make it as easy to get around as possible. But the other thing you can do is you can leave a message on our chat. And you can also chat with somebody live when we have somebody there. So if you're ever looking on our website for things, it should be fairly easy for you. And without further ado, I'm going to stop my share. And I want to introduce our guest today. We all know that restaurants and other hospitality businesses are eligible to deduct most, if not all, of their sales from their gross receipts tax reporting from March through June of this year. This is something that we worked very hard with the bill sponsor, which was Peter Worth. Peter Worth sponsored this bill. He's the Senate floor leader, and it was Senate Bill 1. And you know, he knew that restaurants were going to need some relief, and he really showed up for us. So I appreciate that. And today we're excited to have Tax Policy Director Mark Chaiken and Audit and Compliance Deputy Director Tiffany Smyth of the Taxation and Revenue Department here to help answer your questions about this tax deduction. You know, only 500 restaurants of the 3,500 restaurants eligible to take this took the deduction up until a few weeks ago. And I'll be interested to find out if more have taken it, because we've really tried to press hard to make sure that people know that this is available to them. And in this webinar, we'll be talking about how to take the deduction without getting in trouble. So, and then time permitting, Mark and Tiffany may also discuss, there's been some significant changes to the gross receipts tax and to the state tax filing system. And those are coming at the end of this month. And so they're going to talk about that as well. So welcome, Tiffany, and welcome, Mark. Thank you for being here.
Thank you very much, Carol, and thank you for the opportunity to be here and to talk about this deduction with your membership. As Carol did mention, only about 500 restaurants that we're aware of sitting here today have taken this deduction. I don't have more updated information than you do, Carol, I don't think. And we're looking at only about $9 million, I think, that's been claimed for this deduction. So we want to make sure that everybody knows that this is available and what you need to do to take it. I'm going to be talking about the policy and about the law in general. And then Tiffany will be discussing how to actually apply for and take the deduction. Um, so as I think everyone's aware, this was Senate Bill 1 of the 2021 regular session. And this was, so it's obviously a very important bill. Senator Worth had this ready to go at the opening of this session. And what this deduction is, it's first of all, it runs from May 1st through June 30th of this year. So it's March, April, May, June, just 4 months. But pursuant to this, to the law, excuse me, you'll be restaurants, or actually defined as food and beverage establishments, will be able to take a deduction for receipts from the sale of prepared food or non-packaged beverages that are served or picked up at the food or beverage establishment by or delivered to customers for immediate consumption. So that's the first thing that we want to make clear. It's not just people who are eating in the restaurant, assuming that your restaurant is open for business again at some level of capacity. It's not just for food that is eaten in the restaurant. This deduction applies to food and non-packaged beverages also that are picked up by the customer or delivered to the customer. So it's, I know a lot of restaurants, especially during the height of COVID, but even as we've come down from the worst of it, a lot of business is now delivery business or pickup, takeout business. So first thing to make very clear is the deduction is available not just for in-restaurant dining, but for sales of prepared food or non-packaged beverages that are picked up at the restaurant by the customer or delivered to the customer. And I'm going to talk a little bit more about delivery in just a minute, because I know there are some questions about that. The deduction is applied only to gross receipts that remain after all other allowable deductions have been taken. So if you have other deductions that are available to you, you need to take those first, but then this deduction is available for the remainder. So it is, it's fairly simple in concept, right? You get a deduction for your receipts from prepared food and non-packaged beverages. There are a couple complications that I'm going to talk about. The first one that we've heard a lot about concerns the definition of what is a restaurant. And the bill states that a restaurant does not include an establishment commonly known as a fast food restaurant. So that's sitting here today, that's where we've got most of the questions. And I suspect that a lot of folks may be reluctant to take this deduction because they're not sure whether they qualify as a fast food restaurant, which means they would not be eligible for the deduction, or whether they're a restaurant within the meaning of the statute and therefore they can take the deduction. So the legislature actually did us a favor. It may not seem that way, but they gave us quite a lot to work with in the body of the statute, which is somewhat unusual, but we're very grateful for it at TRD. So a fast food restaurant is a restaurant that dispenses food intended to be ordered, prepared, and served quickly with minimal or no table service, and prepared in quantity by a standardized method for consumption, and that tends to have any of the following characteristics. So the use of the words "and" in the statute means that all those factors have to be present. So there's three things. There's, first of all, you have to be a restaurant that dispenses food intended to be ordered, prepared, and served quickly. So the classic example that probably most people think of when they think of fast food is like a Wendy's or a McDonald's or a Burger King or something like that. So that's the kind of food it's not pre-prepared, but it's prepared very quickly and it's served very quickly. So generally while you're standing there waiting at the counter, they take your order and you get your food within a matter of minutes. With minimal or no table service. And this has really been key for us in order to determine who is a fast food restaurant and who is not. So minimal or no table service, what that really means is there somebody, a wait person or other staff who comes to your table, so you're seated at your table as a customer, and staff comes to you and they take your order and they take it back to the kitchen, and then they bring you your food, and they're servicing you also during that time, you know, cleaning the table, filling up water glasses, bringing you additional condiments, the typical kinds of things that we would expect wait staff to do. So that's really key. If you have minimal or no table service, meaning that there's no one who comes to the table to place the order, but rather the customer has to approach a counter and place the order themselves. And then the food may still be delivered to the table by a wait person. But again, that's not going to qualify as table service. That would really be minimal table service. So if the customer is having to order their own food, that probably means that you have minimal or no table service. Certainly other things like if the customer is bussing their own table, clearing off their own table when they're done with their meal, or if there's someone who is just in the restaurant who goes around cleaning up tables but isn't dedicated to a particular table, isn't assigned, you know, a particular section of the seating as would customarily be the case, then you're probably having minimal or no table service. So that's we found that that's really a key distinguishing factor for determining who is a fast food restaurant. Understanding, of course, that we can't really have a bright line in the statute, and there is no time to draft and implement regulations because that takes about 90 days. So by the time that this was in place, there was simply no time for us to do regulations. Because the deduction will end at the end of this month for sales at the end of this month. So that's the first thing. You have to be a restaurant that dispenses food intended to be ordered, prepared, and served quickly with minimal or no table service. The second is prepared in quantity by a standardized method for consumption on and off premises. So prepared in quantity by a standardized method. Again, you know, if you think of a grill going that has I guess many fast food restaurants will receive their food pre-portioned, frozen, or maybe fresh, but still pre-portioned. And so they just take that burger or chicken fillet or cutlet or whatever and throw it on the grill and cook it, or microwave it and cook it. That's, I think, fairly common sense. Again, it's very hard to draw a bright line here, but I think it's sort of intuitive what the legislature was talking about here. Is stuff where there's you don't have a chef who really puts a lot of artistry, for lack of a better word, into the preparation of the food. It's stuff that is prepared according to formula. So you could also have, for example, a pizza parlor where the dough is delivered, not made on premises, where there's a standardized amount of cheese and sauce placed on the pie once it's prepared, where there's a standardized amount of additions like pepperoni or peppers or what have you that are placed on the pizza, that often those may come in a little plastic packet, or there's a measuring cup or something that the preparer has to use. So again, I think that's fairly intuitive, but there obviously can be cases that are going to be sort of in the fuzzy area. So those are the first two factors. The third is a set, and it says that tends to have any of the following characteristics. Number one is a menu consisting primarily of pre-cooked items or items prepared in advance and heated quickly. I think that's pretty self-explanatory. Placement of orders at a fast serve drive-through or walk-up window. Again, I think that's fairly clear what that is. Service of food solely in disposable wrapping or containers. And I think, you know, there again, we're talking about clamshells or, you know, I personally, I'm from New York City, and a long time ago now, but little takeout containers, little cardboard takeout containers with a little handle. But I want to note the service of food solely in disposable wrapping or containers. So if you're a restaurant and you're giving takeout or pickup or delivery, and so of course your food there, you're putting in exactly those sorts of containers. But if in your restaurant, in the main dining area, you're using china and cutlery, then you're not solely serving food in disposable wrapping or containers, and that wouldn't apply. So look very carefully at that word solely there, because that really means that your sole business is the only way that you serve the food is in that disposable wrapping or container. So again, if you're just using that for takeout, you're not going to fall into that category, what that's trying to capture there. And then the last one is a menu that exclusively sells hamburgers, sandwiches, salads, and other fast foods. Of course, that is a little bit circular because a fast food restaurant is being defined as something that exclusively serves fast food. But again, the classic fast food restaurant would be a McDonald's or a Burger King or similar like that, or sandwiches, we're looking at a Subway or a Quiznos or a similar type of thing. So again, it's looking at food that is generally pre-portioned, that can be either pre-prepared and heated up, or can be cooked very quickly for a service, and not not something that's going to take a great deal of skill to prepare. So that third set of conditions, the A, B, C, and D that I just went through, those are all ors. So any one of those will qualify you as a fast food restaurant if the other two conditions also exist. So again, the law states three things. One, you have to be a restaurant that dispenses food intended to be ordered, prepared, served quickly with minimal or no table service. Number two, the food has to be prepared in quantity by a standardized method for consumption. And number three, if any one of those four other conditions apply, then you're probably going to be a fast food restaurant. We do encourage you, if you think that you're in a gray area, you're not sure, we are trying to respond quickly to questions that we get about this. So you can call the call center. You can send an email to us at Tax Policy, and our email is policy.office@state.nm.us. And in fact, I can put that in the chat. I'll do that when I'm done speaking. So that's the main question. The biggest question we've got is, well, am I a fast food restaurant? Do I qualify for this deduction? And so I hope that that was all helpful, what you heard just there. Another issue, and this is sort of unique to this legislation, and that's why I want to point it out. Generally, a gross receipts tax deduction means that you simply don't request payment of tax on those receipts, right? Normally, if you were billing a client or a customer, you would say the food costs this much, and then you separately break out the gross receipts tax, and you charge them that. So this legislation is very interesting because there's a provision that states any amount passed on to a customer in lieu of a gross receipts tax on receipts for which a food or beverage establishment may deduct pursuant to this law shall not be considered gross receipts. And what that means is, say you're charging your customer $10. They've ordered $10 of food. Normally, say your GRT rate is 8%. Normally, you would charge them $10, and then you would break out the 80 cents of gross receipts tax, and the total bill would be $10.80. But when there's a deduction, you wouldn't charge it at all because there is no tax due on those receipts. So you might just charge the $10. But here, Senator Worth was very concerned to try to get extra money into the pockets of restaurants. Not just to give them the deduction, because the deduction doesn't really get the restaurant anything. Maybe it spares you a little administrative burden. Maybe you get a little bit more customers because their food is cheaper. But generally what the restaurant is doing when they charge the GRT is charging it and passing it on to TRD and to the state. So they're really just an agent of the state in a sense for collecting that tax and then passing it on. But what this provision does is says, no, if you're the restaurant, you can actually still charge what would have been the gross receipts tax, and you get to keep it for yourself. It's not receipts, no taxes due on it, and you get to keep it. So in that example I just gave, you could still charge your customer $10.80, but you would keep all of that. You would not pass on the 80 cents to the state. And so that really means that in one sense, your prices are higher. You're certainly collecting more money for the product that you're selling. But the state wants that, and they want you to keep that extra money. This is also going to come into play in terms of deductions because, refunds and rebates, because now if you're applying, if you did charge the tax and you remitted it over to the state because you weren't sure, but now you think, hey, I do qualify for this deduction. I want to get a refund of the amount that I paid as tax that I didn't actually owe as tax. You're going to get that and keep it, and you don't need to try to return it to your customers or anything like that. Again, that goes directly into the restaurant's pocket. So that should significantly help your bottom line. And that was really the intent of adding that section to this bill, was to get more money into the pockets of restaurants. So it's your choice as a restaurant to whether to charge that or not. But if you do charge it, you get to keep it. So basically, it was a choice of whether to essentially reduce your prices and try to increase the volume of business, or to charge it and keep the extra money. So those are the highlights of the bill. The other question that we've got a few questions on is, what about marketplace providers, delivery services? And I see from Carol, there's a comment, and that's correct. Fast food cannot take this deduction. So thank you for clarifying that, Carol. So the other question we've got is, well, this applies to restaurants, to food and beverage establishments, but what about Doordash or something like that, or Uber Eats, someone who will actually take the order for the food, pick it up from the restaurant, and deliver it to the customer? So more than just a delivery service, they're what we call in the law a marketplace provider, which makes the restaurants who use them marketplace sellers. So the marketplace provider, according to the law, its receipts are everything, not even though the receipts for the food are also the receipts of the restaurant, under the law, they're also considered to be the receipts of the provider. And what that means is that there's a risk that the provider could have collected those receipts even if the seller didn't charge them, or if the seller did charge them, the provider passed that on. And that's how it will generally work. The provider will charge the customer and collect all the tax from the customer and pay the taxes on to the state, and the seller gets a deduction, and so they don't generally need to worry about it. There's a special deduction for marketplace sellers. It's a type of sale for resale deduction, because the way the law looks at it, even though that's not really what's happening, is that the seller is selling the food to the provider, who's selling it then on to the customer. But we're shortly going to be putting out advice, and this is actually already in some regulations, but the provider also is entitled to the same deduction. So if the seller is saying, I have $10 worth of food, that's what the customer's ordered, the seller doesn't charge the tax, neither should the provider. If the seller does charge the tax, the provider should turn over 100% of what it gets from the customer to the seller. So again, seller sells $10 worth of food, says, I'm not charging the tax. The provider should also not charge the tax, but should just charge the $10 to the customer. Second situation, the seller says, yeah, I am going to charge the tax, but I want to keep it, which the law lets me do. So I'm going to charge $10.80. The provider also charges that amount, and it has to return the entire amount over to the seller. Where this actually came up is we had a provider who the seller had charged the tax, and the provider had collected it and then remitted it over to Tax and Rev, to the state. And now they want to get a refund for it. So what we recommended is that the provider enter into an agreement, and we at Tax and Rev would like to see a copy of that agreement saying that the provider can apply for the refund, but it has to have a written agreement with a seller to turn over to the seller any amounts it gets back as a refund with respect to that seller's sales, right? So if the provider is saying, oh, I collected the 80 cents, but I paid it over to Tax and Rev and to the state because that's what I thought I was supposed to do. But now I realize I'm entitled to get that 80 cents to the seller. The provider should work with the seller to claim the refund. Again, the provider is the person who collected it and paid it, so they have to apply to the refund. But at Tax and Rev, we're going to want to see evidence, first of all, that there was an agreement from the provider to pay that to the seller, and then evidence that the provider actually did pay that over to the seller, so that so that we can have proof if there's an audit that everything was done correctly and the money made its way to the correct person. The purpose of this legislation was to support restaurants, not marketplace providers like Doordash or Uber Eats. It was meant to help the sellers. It was meant to help the restaurants, not the internet companies who facilitate the sales. So again, if that's happened, if you have a restaurant and you've been working with someone like DoorDash and you've been paying over or they've been collecting the GRT and paying it over to the state, you can work with them to get a refund and to get that money back in your pocket, which is where it belongs. Those are the main points of the legislation. Carol kindly put my email in the policy office email in the chat. So I understand this is like a 10,000-foot view of what's going on. But if you have any questions, I do encourage you to email me or to call the call center, and we'll try to get you responses as fast as we can. Tiffany is now going to show you how the mechanics of this thing actually work.
Thank you. Mark went through the hard part, and I'm gonna hopefully show you the easy part, which is, once you qualify for the deduction, here's how you actually take it on your return. So let's see here. Take a second. Are you guys seeing my presentation?
We have you, Tiffany.
Okay, so here is the technicalities for how to file on the returns. So for paper filers, they are going to report all their receipts by location using a special code on the return, and that's going to be special code P for prepared food and drinks, and that's how you're going to identify your deduction. So here's an example of a paper return that claims this deduction. You're going to see they have an Albuquerque location with the special code P being claimed in column B. And then they're showing the amount of the gross receipts, the amount of the deductions, and there's 0 tax due there. This taxpayer also has an additional location for Bernalillo County, the remainder of the county. And they're using special code P again here for the deduction, and then they fully deduct. And in this example, I'm just showing, potentially what could happen if you have, this taxpayer may have sales that have nothing to do with their restaurant. They might have like a salsa factory and they do wholesales. Those wouldn't necessarily qualify under this deduction. So they would use a totally different line to show, this is their regular gross receipts. There was no deductions. And then that's their taxable portion. So just an example of what that may look like if you had additional gross receipts. So if you are a TAP filer or the taxpayer access point, you're going to do, it's going to be very similar. You're going to select this special rate from a drop-down menu, and you're going to have a separate set of receipts for each location. And then you would add a separate line for those that you're taking that are taxable as well. So one thing I'm going to do is I'm going to show you how it's going to look. Right now, our current version of TAP is it's about to be up in the next 15 days. We're going to go down on June 30th for several days, and when we launch back on the 6th of July, it's going to be a brand new version. So I'm going to show you how you would take this in our current version, and then I'm going to give you a sneak peek on what that looks like in the new system. So I'm going to play this video here for you.
Progress.
Here we are in the current version of TAP, and this is how we're going to add the receipts for the deduction using the current version of TAP. If you want to amend a return, you'll go into the period that you'd like to amend. And under the I want to tab, you'll click File, Change, or Print Return, and View or Amend Return. And again, on the I want to tab, you'll click Amend Return. And we'll move through the first two screens with the instructions and the registration information. And you'll see here there's already receipts filed. So we'll add or edit receipts. Here, we used regular receipts on our first filing, but we'll want to change that under the rate type to prepared food and drink. And one tricky part here is that for this version, you might want to use the full deduction amount here. And it's going to tell you deductions for this rate type are automatically applied and this field should be left blank. So instead of doing that, we're going to take those out. When you take them out, it's going to still show an amount of gross receipts tax due. So we used the special rate but didn't take the deduction. It's going to show $675 of tax due. We'll press OK. Press OK. And you'll see here on the gross receipts tax line, there's an amount, but on the tax due amount line, there's not. And if you had other receipts that should have been filed with that were taxable and not deductible, you would just use a different line to add those back in. So you could add, you actually had $1,000 of taxable receipts. You can add those back in so that you have your prepared food and drink line and then a separate line for the regular receipts if you needed that. And then you'll see again, the amount of gross receipts increased, but you only added the 84 in tax due. And then once you're okay with that, you will digitally sign and submit the return. Are we sure we wish to continue? Yes. And here it's showing gross receipts tax due, but then the total amount of total tax due is 84, and the total amount of tax due is 84 again. Okay. Okay, so I see in the chat there's a question about amending the return. So yes, you can go back and request an amendment if you didn't originally take the deduction. So that's why I'm showing it as an amended return. If you haven't filed the original returns yet, it's going to look almost exactly the way we did. Instead of amending, you'll just file the original return in the same manner. And one thing to keep in mind is that for gross receipts tax purposes, the amended return isn't the same as the claim for refund. So you're going to want to amend the returns, but then you would have to request an with the refund application, the refund. So here I'm going to show you in the new version of TAP what it looks like if you, whoops, let's see here. Let me go back to the slide. If you needed to do it in the new version.
Progress.
Sorry, here we go. Okay, so if you're looking in the new tab after July 6th, and you need to go back and amend a return, you're going to do so in your Gross Receipts Tax account. You're going to go into the account under the File View or Amend All Returns link. And then you're going to go into the period that you would like to amend and click View or Amend Return. Then again, you're going to click Amend. So now we know we're amending the return. We'll see the general instructions page, and then the registration page. And we'll see here the gross receipts that we've already entered on the original return, and we will click Add and Edit the receipts. We'll go into the receipts that we've added, and we'll change the rate type to prepared food and drink. You don't need to take the deductions just like any other version of TAP. We'll press OK, and then OK again. You'll see that there are receipts here in this line, but the total amount due is still showing 0. We'll go to the next screen. It's going to ask if we have business credits, and for this demonstration, we don't. So we'll go to next. You'll see in the summary that we have tax due here, but then on the amount due, it's 0. And then you can confirm and submit. Okay. So I am free to take questions. I haven't been keeping up with the chat. So I'm going to stop sharing so I can view that. I can't tell if the questions in the chat right off the bat are from for Mark or myself, but Mark, if you have anything that you want to ask while I'm kind of getting caught up on the chat.
Yeah, and Mark's been kind of keeping up with it as well. And so we've got some kind of dicey situations here. And I know of other people who have that kind of, well, are we fast food or not? And that is those new kind of restaurants where it's a group of restaurants. You go up to the counter, you order, you go sit, they bring the food to you, but it's a chef that prepares it. You know, it's not a fast food restaurant. It's just a smaller restaurant using counter service. So I'm not gonna try to take that one. This is one of those things that you may want to email individually about, just because there are special circumstances that I'm sure they might want to try to justify to take this deduction.
Yeah, I mean, it's a very, very fact-specific inquiry to determine whether you're fast food. So some of those factors, based on what Mike put in the chat, do seem to be present. But again, you have to have them all there for this to qualify. So if it's not food that's prepared by a standardized method and quantity, then it's probably not a fast food restaurant.
Okay, well, I'm going to let them interface with you, because I think that there's a lot of newer restaurants that have come up in this. You know, a lot of them started in 2019, you know, towards the end of the year, and then they got hit with COVID. And so they've really been struggling, especially because I don't think the governor has been allowing them to stay open. So, so the other question, I think, Tiffany, for you is, how far back can they go to amend for their refund?
So the deduction is from receipts from March 1st and prior to July 1st. So all of those periods, if you used the regular code and filed and remitted gross receipts tax, but you actually qualified for this deduction, you could go back and amend March, April, May, and June. Or June's not due yet, but you could go back and amend and then file starting current for the periods that are not due yet.
Okay, and then somebody has asked, they applied for the March refund about 3 weeks ago. How long is the process to get that refund going?
And that's the refund claim. You know, I'm not certain. I'm not on the revenue processing side, but I would think, you know, hopefully soon that's something I can raise with the director to make sure that they're aware that these are coming in through refund claims, and make sure we're reviewing and getting those addressed. We want to make sure to get the funds to you all.
Wonderful. And Mark, I think this is for you. What documentation should be on file for Doordash and Uber Eats to show that they will be paying GRT when they resume?
I'm sorry, Carl, I'm not sure I understand. Are we talking about the refunds? So what documentation do they need if they're claiming a refund for tax that was paid in error?
Yeah, so my question, Mark, really to you is, are you talking to these major, we call them third-party delivery, you call them
Marketplace providers,
yeah. So are you talking to them? Are they going to take these deductions and remit them to the restaurants? Do you think that's going to happen?
That's really, we had an inquiry from one of those about how, it was all about how they should go about claiming the refund, because they said they'd been collecting the tax and remitting it to the state. So if the restaurant takes the deduction, if the seller takes the deduction, then the provider should as well.
Okay, so that's kind of between you and your provider, or you and your third party, whoever's doing your delivery, you know, and I know they're very hard to get a hold of. You know, it's very hard to find somebody in those companies that's going to answer your questions. So, you know, I'll try to do some background on this as well, and get some information out in our newsletter, but I don't have much of a contact. If any of you has a contact with Uber or DoorDash or any of those, please let me know, because I think this is important. I mean, that's a lot of money that could come back to restaurants. As you know, people are relying much more on those third-party deliveries, and that is a lot of money in the pockets of restaurants if we can get that done.
Yeah, and just to emphasize again, that should be in the restaurant's pockets, not in the marketplace providers' pockets. And so they should be able to document, first of all, they've agreed to claim that refund on behalf of the restaurant seller, and then they should have documentation that proves that they actually did pay it over. And I mean, that could be simple as banking records or other kind of evidence, invoices, paid invoices, things like that just show that they did.
Question, do we need to do a refund request in addition to the amended return? If yes, how do I do a refund request?
Yes. So you can do a refund claim after you do your amended returns in TAP. So you can do that electronically through your taxpayer access point account, or you can do a paper application for refund using form RPD 41071, and that's the application for refund.
Can you put that form number in there as well in the chat?
Yes. Oh, I'm sorry. I sent it to direct instead of to everyone. So I will send that to everyone right now.
So I don't understand, Aline, no normal, and I think she's answering normal GRT processing. They aren't giving NTCs like normal New Mexico business. Mark, I'm talking about after the tax holiday is over, what forms need to be filed. The only form you have to file is your regular GRT, and you just have to do it correctly. Is that, Eileen, tell me if that answers your question, number one, and If anybody else understands it, ask it a different way.
I think she was referring to her question earlier, which was what documentation should be on file for DoorDash and Uber Eats, et cetera, to show who will be paying the GRTs and when they resume. So I think she was going on to say it's normal GRT processing, but the Uber Eats and DoorDash are not giving NTTCs to New Mexico businesses and that information. So she may need to be doing more research on DoorDash, Uber Eats, their processes, and who's collecting what, is how I'm reading that.
Okay, the statute here it's 7-9-117, and it says a marketplace seller may deduct receipts for sales, etc., for tangible personal property that are facilitated by a marketplace provider, provided that the marketplace seller obtains documentation from the marketplace provider indicating that the marketplace provider is registered with the department, and that will be registered with a BTIN, formerly CRS, and we'll see if we have time for that, but basically registered with the department, and has remitted or will remit the taxes due on the gross receipts from those transactions. And I don't think we have regulations in place on that yet, but so you just need documentation showing from the marketplace provider showing that the provider is registered with TRD for purposes of the GRT, payment of the GRT, and that it has remitted or will remit the taxes due. Sitting here, I can't provide you with more guidance. Oh, I see. So you're saying they won't give you any. That gets complicated then. I can see why that would be a concern. If they won't, sorry, now I'm just flipping back to the statute to see if it says what to do in that circumstance.
I was going to say, and there's not an NTTC that applies to this deduction, so that's probably why they're not giving you an NTTC. The NTTCs are tied to specific deductions, and there is not one for this specific deduction.
But
so there's
again,
lots of deductions that don't require an NTTC or didn't need one prior. Now all deductions can be taken without an NTTC with alternative evidence that you're entitled to it.
Right. But this statute does say that the marketplace seller has to obtain documentation from the provider indicating the provider is registered with the department and has remitted or will remit the taxes. So if they won't give you any of that, quite honestly, I'm not sure. I have to think about what you would do in those circumstances. And maybe Tiffany has a thought too, but if they won't provide you with the documentation showing that they are registered and that they are remitting or will remit the tax, I'm not quite sure what to do.
Yeah, and I'm not certain. In my own experience, I've sometimes seen like remittance statements where they're paying you per month. They're outlining how much they've collected and they're backing out the tax and showing how much they've collected in tax. They're not paying that amount back to you. They like sometimes show it as like, here's how much is owed to you, here's how much we collected in tax, and then they keep the tax and pay it. So that type of statement, if it was clear that we've collected the tax, but we're not giving it to you because we're paying it over, that might be the type of documentation that would show it. But I don't know every single platform's style or the way that they show that back to the restaurants. I've just seen that in isolated cases. So that's maybe an idea of something that you might have if they don't have an exact statement. Not as it pertains to food, but I've also seen marketplace providers send a notice just saying, we've begun collecting local tax rates because we're now a New Mexico taxpayer. So like maintaining that email if they sent it, or changed your terms of service that said, we are now engaged in business in New Mexico, so we're also collecting. that might be something to look at. These are just ideas. I don't know what every single provider has.
So go ahead, Mark.
Well, and I just saw Aline's comment, so I have nothing. They won't give us the tax or the tax CRS. I'm writing this down because honestly, it's that is a problem, and we will have an internal discussion about this now. If you have basically an intransigent provider who won't help you to take your deduction, could definitely be a problem. So we'll think about that. I think another way to deal with it is in the agreement between the restaurant and the marketplace provider or facilitator, whatever we're calling it. They need to be required to do that. And I understand that may be a bargaining position, but I'm very curious as to why they would refuse to provide you with that information.
You know, honestly, it's been really hard for restaurants. We don't have good contacts for these folks. So I'm going to ask everybody here, if you have this situation and you can give me the name of your provider, just email me. And you saw it in here, it's executive@nmrestaurants.org. I'm going to try to make some contacts with the National Restaurant Association and on a broader level, the Uber and DoorDash and all of those, and see if we can't at least educate them on this and how important it is. And also, is it illegal for them not to do this in some way?
I don't think it's good faith. Whether it rises to the level of illegality, I'm not sure.
Okay, well, let's try to get some education to them that this is a situation in New Mexico. It's probably not in very many other states, but we would appreciate their help on this because it's going to mean a lot of money back into restaurants' pockets, and I'm sure they're interested in helping restaurants at this point too. So, yeah.
And the providers will be subject to audit, and so if this comes out, it could come out in audit, especially if they end up keeping receipts that rightfully belong to the restaurants.
Got it. Okay, now I know you guys have a couple of other things and we didn't leave a whole bunch of time, but I think it is important to at least mention that there are two other major changes. You saw one of them, which is the website and the reporting is changing. And then the other one is that we are doing location-specific GRTs. So talk about that real quickly.
Okay, Tiffany, do you want me to go first on the destination sourcing?
I'll just quickly say the CRS system starting in July is going to be broken down by tax program. So you'll have separate returns for every program that you file. For withholding will have its own return, gross receipts tax, compensating tax. So if you haven't already, please go to our website, watch all the videos. We have a YouTube site up with a playlist. So there's a lot of information on that. And I'll let Mark kind of discuss the destination-based sourcing.
Thanks, Tiffany. Yeah, so this is a big change. Destination sourcing basically tells you what tax rate to apply to your sales. Sorry, I'll try to do this in about 3 minutes. Currently, New Mexico uses what's called origin-based sourcing, which means that the tax rate you apply is the tax rate at your business location, so wherever your restaurant is located. Say you're in Albuquerque, you use the Albuquerque tax rate. And so that tax rate is equal to the basic state rate of 5.125% plus any local options that your city or county or other taxing jurisdiction has put on top of that. And so, as most of you probably know, rates can vary from 5.125% to over 9% at some locations around the state. So currently, until June 30th, up through June 30th, you use where your business location is. But after July 1st, we're moving to destination sourcing. So you look to where the product is delivered. So this can be very complicated for restaurants. So two scenarios: you have a restaurant and you have a customer who comes in and either eats the food in the establishment or picks up the food themselves in the establishment and pays for it and leaves with it. you're still going to be using your business location because that is the destination, right? That is where the food was delivered to the customer. The other scenario is the DoorDash type scenario, or if the restaurant does its own deliveries. For example, I guess Domino's has their own cars. I see them around. And you call up and they say, where's the food going to? You give them an address. The location code for that address is going to give you the tax rate. So it may not make a difference to many people, but if you have a delivery service as part of your business model, it will. And for example, it can get complicated in Albuquerque. One of our colleagues lives in a house that's in Albuquerque, but it happens to be in a little pocket of an unincorporated part of the county within the city of Albuquerque. The boundaries are kind of weird. There's this little pocket inside the city that's actually not the city, that's actually part of the Bernalillo County. So they're going to have a different tax rate. So if you're, say, a pizza delivery place and you're delivering around Albuquerque, you have to be careful because sometimes your destination code, your tax rate, therefore, is going to be different depending on where you deliver it to. Now, there's a really, really good map that is up on our website, and there's several ways to access it from our website, but it was prepared. It's great. You type in your address and it tells you what the location code is and what the tax rate is. So that should make everybody's life a little bit easier. The other thing that will make your lives a little bit easier is there's a part of the regulation, and these will be going into effect next month, that says you can use reasonable estimates. So if you have a reason to believe that 20% of your business, say you're right on the border of Santa Fe County and Rio Arriba County, and you know that 80% of your business is being delivered to Rio Arriba and 20% to Santa Fe, you can use those estimates. And you don't actually have to track each and every sale. So it is a little bit easier. We've tried to make this easier on folks. But this is in statute, so there's only so much we can do through regulation. We cannot vary the law through regulation. But we hope that for most restaurants, it won't be a problem. Certainly for purposes in restaurant dining, it won't make any difference to you. It's only going to make a difference in terms of deliveries. And you need to use the location, the reporting code of the place to which the food is delivered. And that will be effective July 1st.
Great. Tiffany?
I'm sending a bunch of links to the group for the rate map, for the YouTube that has a video on how to use the rate map, and a bunch of information on, I sent the CRS redesign page and the frequently asked questions. So there's a lot more information since we didn't have that much, but great 3-minute tutorial there, Mark. Thank you.
And thank you for posting those. We do have a lot of bulletins and videos and other stuff on the website that explains all this. So I encourage you to go onto our website and spend a little time looking around.
Wonderful. Well, we really appreciate it. I'll tell you, I know you guys have done yeoman's work in changing the reporting system and then trying to get people to understand how to do it, because it is, I guess, everybody that's a taxpayer is going to see something new when they go online next month. So yes, somebody asked if we can email these links to them, and we will do our best to email those, but we'll also put them along with just a news article on the changes that are coming to the Taxation and Revenue Department. So we'll put these as links in that as well. And I thank you all for being here. I don't want to keep our guests any longer. If any of you have questions that you want to ask that are outside of taxation and revenue, because once I let our guests go, I'm not going to answer those questions. I am not a tax expert, nor am I a lawyer. Have to say that every once in a while. And so I do want to say thank you so much. I didn't introduce him, but Charlie Moore was the person at the Taxation and Revenue Department that contacted me And we got this set up, I think, in 2 weeks. So really appreciate you setting this up, Charlie. Mark, thank you for being here. And Tiffany, thank you so much for sharing with us. Really appreciate everybody for being here. Like I say, I'm going to stay on for a while. I will take it off of record. So we've got Tiffany's email up here. We've got the email to the department, and we will keep those and send those out. So thank you all so much. Really appreciate it. Anybody wants to stay can stay.
Thank you so much for having us and helping us get out the word. We're happy to help get you guys the refunds or the credits that you were entitled to.
Thank you. Very much appreciate it.
Thank you.